All right, Matt, I believe we are live. Guys, my apologies for being a few minutes late this morning. I was telling Matt this time change has whipped me. For one to be on a schedule all the time, this one has got me for some reason. So I've been oversleeping the last couple of days. So anyway, happy Wednesday to all of you. Guys, if you are watching on Facebook, please hit the like button, leave us a comment, let us know that you guys are in here with us. If you're watching on the Zoom side, leave us comments as well if you've got any questions along the way. Guys, throughout the show, if Matt or I either one say anything that you all have questions about, please just drop them in the comments. We'll be glad to look at those and we'll try and address them the best we can. And truthfully, guys, we love comments. We love questions that we can help. We love the interaction. So anything like that definitely helps us. But anyway, we'll go ahead and get everything started off. One little reminder so far, guys, today is March 15th. So for those procrastinators who have not done your taxes yet, you have a month left, to really get everything in. So make sure that you guys are paying attention to those dates and get those in. And our apologies for for not having a meeting last week. We forgot that Matt actually had a CE class that they were teaching. Which reminds me, Matt, you've got another one coming up. When is that one? Do you know right off?
Yeah, next Tuesday morning at 9 a.m. We're doing this one's not a CE class, so I want to be transparent about that. But it's a reverse mortgage training class, basically. So help people figure out if that's a better option for some of your clients.
Awesome. So guys, pay attention. We will be putting some more links into the group. That way, if you guys want to sign up and join in for that, you're welcome to. Matt, will that one be streamed online as well, or?
Yeah, I do actually plan to live stream it to this group.
Okay. Well, so anyway, no, Harner, last week it would have been difficult to do it solo. So anyway, guys, we'll go ahead and get everything started this morning. Again, happy Wednesday. It's crazy to think that we're already to March 15th. That means that we are about 2 weeks away from the end of the first quarter. So, as I've said before, now is a great time to be analyzing where you are, taking another look, auditing your time, auditing where you are, because this is going to set the pace for, the spring market, which seems like we're here. And, it's going to set the pace for the rest of the year. So over the course of this year, we have really dove in and we've talked a lot about expansion. We've talked about casting those large nets, being anywhere and everywhere, trying to be in as many places as we can. And, we've talked about how to be persistent in our actions and things. And guys, today we don't really have a direct topic we're going to hit on today, but we're going to talk a little bit about real estate in general, some things that have been going on around us to hopefully try and shed some light on some things. And again, we're just going to talk real estate today. So Matt, one of the things that I've been seeing a lot on lately, and I'm sure everybody else has too, the bank in Silicon Valley obviously has been a hot topic. Can you shed some light on what that means to us? Because I've seen a lot of fear things. I've also seen the things where from our perspective, we shouldn't be too scared and all that. But can you shed some light on that from the mortgage side of things?
Yeah. So, first off, if you don't have any money in Silicon Valley Bank, then probably no direct impact to any of us here. However, that is a bank that was processing a lot of the payment type stuff for a lot of the internet. I guess you'd say it that way. But essentially what's going on there is whenever we hear of the federal funds rate getting raised and all that stuff, that impacts the amount that it costs a bank to borrow money. That really doesn't directly impact mortgage rates. For those that don't know yet, hadn't seen the 50,000 things over the last 2 years about how that doesn't directly impact mortgage rates. It does not directly impact mortgage rates. But what's happening is basically for the last, 6 or 7 months, maybe more, we've been working on what's called an inverted yield curve on treasury bonds. So basically what that means is it's actually, you get a higher rate of return on a short-term investment than you do a long-term investment, which is backwards. It shouldn't be that way. It should be that the longer you hold on to it, you get a better rate of return. But that's not what's going on right now. Well, to put it in the simplest terms possible, they had a poor investment strategy at that bank, and they kind of got caught with their pants down. And there was a run on the bank. A bank's only required to have 10% of its money liquid. The rest can be invested in various ways, however. And they ran out of money, so they went out of they went out of business. You know, kind of Great Depression stuff is what happened. The other thing is that's particularly rough about that situation is that the FDIC insures things up to like $250,000. But that's how much of deposits get insured. Well, if a business was processing their payment transactions through that bank, they probably had more than $250,000 in that bank, a lot more than $250,000. So I do see that it could potentially cause a trickle down effect to the different businesses that did their banking there as well, which is obviously going to have an adverse impact on the economy. But all that to say, whenever the news broke that that bank was basically sunk, the bond market for mortgage bonds increased significantly in like a day. Then it increased even more significantly the next day. I mean, we're talking, we cranked the time machine back to, back to basically mid-December or September were the last two times that things were in this range with the bond market. Obviously, that's a good thing for buyers. However, on the other side of the equation, the thing that's most directly like news like that breaks, it's going to impact markets. But every month, the economists will release a jobs report and a inflation report, the CPI. The thing that's going on there is if unemployment gets worse, you'll see mortgage bonds improve and therefore interest rates get better. It takes something generally bad to positively impact interest rates. Hence the whole thing where interest rates were really sweet when we were in a global pandemic. Same thing with inflation. As inflation comes back down, you'll see interest rates get better. The problem that I'm seeing with those two things right now is the jobs reports and the inflation reports have been modified as far as how they're reported on. Mm-hmm. So what we're looking at happening is they're not a super accurate reflection of what's actually going on in the economy. Unemployment's down, but unemployment is down because hospitality industries are increasing employment. We're really close to having those industries staffed up like they were before the pandemic. So once that happens, the people that are getting laid off from the other jobs, they're not going to have that option to go to keep themselves employed. And that's, in the next couple of months, I see that foot dropping. On inflation has been trickling down ever so slightly, but it almost feels like we're stuck in a gridlock. And the Federal Reserve, the way that they're adjusting the federal funds rate is they're looking in the rear view the entire time. They're saying, okay, what's the last report say? What's the last report say? Because the report that came out on inflation this week was the report for February. And then they're making their decisions based on what happened last month. From what I've seen and every economist out there has seen, it seems like they are making their decisions as if they're driving the car staring in the rearview mirror. It doesn't take long in doing that before you're going to crash into something. And I think that that's where they've run into this banking situation. They made incentivized because of the short-term yields. The banks were incentivized to invest in a poorer way. And now those, because they were short-term investments, those investments have kind of come up and they're done. And they can't get the money they need to reinvest and keep growing. And that puts you where we're at today.
Matt, one of the questions that has come in on the Facebook side, they're asking, do you see this rate dip continuing in the short term? Based off what you know and all that, do you see it continuing in that direction or?
I do think that it's going to continue to go down over some time here. However, just to give you guys some insight on it, I'm going to use rough numbers. So I'm obviously not looking at the charts right now, but Thursday and Friday last week's when the whole Silicon Valley Bank thing kind of came out. During that time frame, one of the days the market closed up like, I don't know, 60 or 70 basis points. Then the next day it closed up like 80 or 90 basis points. But then the inflation report came out. I'm sorry, that was Friday and Monday. But then the inflation report came out on Tuesday. And the market took a dip of about 40 basis points because the inflation report wasn't reflective of inflation being that significantly improved. So the issue that we're running into right now is that I think that the Fed probably overreacted with how far down they pushed everything during COVID, but then now they've overreacted the other way with how far they pushed everything up. And, we're kind of, I think it's stuck in a little bit of gridlock. I don't think there's going to be any significant improvement unless the unemployment numbers come out next month and they look a lot worse. And then, that'll help inflation because if people don't have jobs, they're not spending money.
Gotcha. So, well, I mean, there's a lot of information to take away there. I mean, honestly, I think over the last couple of days, I mean, I know with me and my team, we've seen more activity on the buyer front. I mean, we're seeing some more leads come through. We're seeing more activity from the leads. I mean, I know that pretty much all this week, my crew has all been scattered, showing properties, et cetera. I had a report yesterday that one of my agents was back into a multiple offer situation. I wrote another offer last night. I'm pretty sure it was going to have multiple offers. I never heard if any other ones came in, but I'm pretty sure it was going to. So, I mean, the way I look at that is, we're seeing all this disruption right before the spring market, which honestly, in my opinion, could help us have a great spring market, because if it does push those rates down just enough for the buyers to feel confident and to see, or to feel like they've got more leverage, I think we're going to see more activity with them coming out of the gates and looking and making offers. So, but no, I mean, and guys, with that being said, I want to kind of transition into this here. I mean, the spring market is here. I mean, obviously spring breaks have been going on. Like I said, my whole crew's been out looking, showing properties, pretty actively over the last couple of weeks. So the spring market is here. And that's another reason why we've got to take this time to reevaluate where we are. Sorry, I don't know if something just happened on my computer or not, but I'm afraid it did. I know I'm good on your end, aren't I, Matt?
Yeah, I'm good.
My computer screen just went black, so I'm not sure if I'm actually live. And I can't see anything. It almost looks like it's trying to reboot. Guys, sorry, bear with me just a second until I can figure out what's going on with my screen. I can't see anything. Well, if y'all can hear me. Okay, I just got a text that says we are good. So evidently it's just on my side. So
Okay.
yeah, guys, keep me up to date because I can't see a thing on my computer screen right now. It is dead. So anyway, guys, the spring market is here. These are the buyers. If you were in the industry last year, August, September, and all of your buyers were saying, well, I'm looking to do something by spring, I'm looking to do, guys, now's the time to be following up with these people. And one of the things that I have learned over the years is, as humans, we have way too many emotions tied into our day-to-day activities. We have way too many emotions tied into our daily work. And what I mean by that is, if we're making phone calls or prospecting, or it may be text, maybe emails, whatever the source is, door knocking, there's going to come a time where you are going to find yourself in a situation where you say, well, I feel like I've done X, Y, and Z. Well, how many times have you done it? Well, I've done it 2 or 3 times. Well, I don't want to be a bother. But guys, we've got to change that mindset. And this is something that has been a crucial play for me in my time. But basically, I would catch myself making, however many calls a day. And, if you've got 4 or 5 bad calls or 10, 15 bad calls, whatever, Well, by the time you make the next one, you're drained physically, emotionally, mentally. We're tired. And at the same time, as we are doing these calls and prospecting, even if you've got 20 great calls, we're going to get tired. And there's going to come a time where you say, well, I just don't know what else to say. I don't know what else to do. Guys, it's in these moments that we find ourselves, and this is where we find growth. And one of the things that I have learned over the years is when I truly feel like I'm tired and I truly feel like I have done everything that I can, that's the moments that I personally try and buckle down and study and learn the most, simply because I want to train my body to push through the fatigue. I want to train my body to push through. And guys, what we do is as much physically as it is mentally and emotionally. We have to be physically able to push through, because again, our body's going to tell us, no, we're tired, we don't want to do this, or we don't want to be a bother. But it's in these moments that we have got to be trying to figure out any way and every way to cast a large net, to make sure that we are anywhere and everywhere. Because guys, right now there is a mass exit of real estate agents in our industry. Agents are getting out of the industry left and right, and they may not be directly out of the industry per se. They may still have their license hung, but now they're picking up second and third jobs. Now they're having to rely on the full-time agents to pick up their showings, to pick up their listing appointments, to help their clients, because they're not there. So right now is the time that the growth is going to be happening for all of us. If you spent last year working on systems, guys, it's time to work those systems. I've been telling Matt and my crew for a while. I've worked more here in the last little bit than I've worked in a long time, mainly because right now is the time that I know that the growth opportunity is there. Now's the time for my team and I to take up more market share. And, if you are on teams or single agents, whatever, now's the time for all of us to be picking up more market share. And, yes, we're having to get creative. We're having to, I was at an appointment the other day and they said, the brokerage fee was too high. Well, guys, we're going to start seeing more and more brokers coming in and undercutting us, regardless of what we list at. We're going to start seeing less commission being offered to our buyer's agent. So now is the time that we've got to be doubling down. We've got to make sure that we're following up with all those clients that had been in the system for 6 months to a year, however long ago it was. Now's the time to be focusing on those past clients. And that comes down to, the 4 pillars that I talk about, where, every single day we have the routine, and every single day we have our 4 pillars that we hit on. We've got to follow up with our new people. We've got to take care of our current people. We've got to take care of our past people. And then we got to focus on writing a contract every day. And guys, by doing this day in and day out, by focusing on those 4 pillars, you will eventually see that all of a sudden you have no listings, you have no buyers, no contracts, and then all of a sudden you've got 1 or 2. Well, then the next month it may be 2 or 3. And you start seeing that domino effect. And so right now is the time that you've got to be implementing. Don't worry about tweaking a whole lot, but we've got to make sure that the systems are in place. We've got to make sure that we are implementing the systems. We've got to make sure that we're trying them. And more importantly than anything, we've got to make sure that we are showing up every single day to do the work that we're meant to do. Because guys, one of the biggest double-edged swords that I have seen is, the beauty of being self-employed is we can pick whatever day, whatever time frame we want to work. We've got freedom. And let's face it, that's probably why a lot of us got into the real estate industry, was for the freedom. Well, at the same time, we can work anytime, anywhere, any place, whatever. But do we? I have seen it time and time again. Agents will say, well, I'm going to go to the gym midday, but yet that midday disrupts everything else for the rest of the day, and they don't get back into the office. Furthermore, they didn't even show up to the office in the beginning hours because they planned on doing it later, and they had that disruption. So in this industry, we have got to make sure that we're working it like a full-time job in a sense. Honestly, for me, I work it a lot harder than I used to work my full-time jobs. I put in a whole lot more hours than I used to. When I was punching the clock, I was happy to get my 40 hours and get out. Well, now as being a self-employed individual and being in this real estate business, guys, there's weeks or days that I put in 12, 15 hours a day. Well, that's the beauty of what we do. That's the beauty and the freedom that we've got. So you know, if you all, yeah, sorry, my computer's still messed up, so hopefully everything's working right. But anyway, now's the time that we've got to be auditing our time. We've got to be making sure that we're working the systems and that we're implementing those ideas and that we're following up with all these people that we have dealt with in the past. Because the ones who said they're waiting on the spring market, and here's another thing, guys, all the agents that were complaining because the market was dead and they were all sitting there waiting for that spring market to come in to help get their boost. Guys, it's here. That excuse is gone. It is now here. And if you are not showing, if you're not out listing properties, showing properties, talking to clients, guys, the excuse is you. So now's the time to be putting all that to the side and making sure that everything's working, because again, the spring market is here. And over the next couple months, we're going to start seeing some numbers. And historically speaking, generally, and I know this is true on my side, I don't know if it is on your side, Matt, but generally speaking, March and April are two of the largest months that I generally see throughout the year. I mean, do y'all see that on, I mean, is that when y'all normally see your all spikes on the mortgage side?
Uh, Speaking for myself, I typically spikes in applications, yes, but I'll typically have most of the closings start happening in May and June, and then in July there's typically a little lull because I guess everybody's gone on vacation in June and don't want to close in July, and then in August and September it'll get huge again. But that being said, the biggest month I've ever had in my mortgage career was a December. So like, it doesn't really matter. Just
Sure.
talk to a bunch of people. I know that a lot of people they'll be like, school's starting, school's ending, whatever. But at the end of the day, if it's a family that doesn't have children, or it's a family that's moving within the school zone or whatever, if it's a family that's relocating for a job, then that school doesn't matter.
Well, something you said right there, Matt, is, you said that one of your biggest months was in December one time. Guys, here's another thing that I see a lot. And I don't know if this is I don't know the right way of saying this. It may be a false security, maybe. But basically, I think a lot of agents come in mentally saying, well, the market's going to pick up in spring. Well, what happens? Well, we're hibernating over the winter months, essentially. So whenever the market does, yes, we will start seeing some more activity. But I think agents come out. I think agents start working harder in the spring because they know that spring market's there. And when I first got into the industry, I heard a lot of agents saying that, the market's going to die around Christmas time. Guys, I don't know that that's accurate. I mean, as Matt just said, one of his largest months was in December. I think what happens is, truthfully, around Thanksgiving, a lot of agents start spending more time at home. They start going on more family vacations. They start taking more trips because we have Thanksgiving. Then it seems like Christmas is right around the corner and we all have to go to 10 different Christmases. And so I think what happens there is, and the reason that the market truly dies off, is because the agents quit working. And I think that, I think that all the agents have that in their head when they come into the industry. It's like, well, the spring market's going to be good because that's when the sun's going to come out. No, it's generally when the agents start coming out. Guys, I mean, here's the thing. The agents who have continued to work, we've been fine. We didn't see those huge drop-offs. I mean, yes, we saw some because, I mean, it's just part of the market. But that's when we got to turn up the heat and work. And I think the agents who really come out in the spring, really crushing it, well, I think that's because of the seeds that we sowed in the winter months whenever the sun was down, before everything picked back up. So, I mean, that's kind of my reasoning behind all that, Matt.
Yeah, I mean, this most recent December, just to be clear to everybody, was not my biggest month ever. But the thing that I noticed through December, we essentially just quit calling agents after about the first week of December and shifted gears to let's do some maintenance work on our systems. Let's get some things done that we haven't had the opportunity to do. The reason we did that was because the rate of scheduling things went down to just absolutely miserable because the conversation. But yeah, I'm kind of just taking the month off, chilling out until January or so. I mean, that was over and over again. That's what the conversations look like. And like, I understand that there's a lot of people that probably aren't interested in unpacking boxes and setting up a Christmas tree all happening in December. but there's still crap to be done. There's still things that some of the people I've got right now that are actively shopping are people I started having conversations with in December.
Mhm.
The thing that Patrick mentioned, a lot of his agents out looking over the last weekend or so. I have had 2 people in the last 3 days write offers. Both of those are multiple offer situations already. Like, whenever rates were super low and the pandemic was ongoing, the complaint that everybody had was like, well, the market's too tight. There's not enough inventory. My poor buyers can't get a house. Well, then the market slowed down and it was, well, the rates are too high. Don't fall into that trap. Like, there's something out there for somebody. I know several agents that they're really not down. Now, your level of activity, my level of activity has had to increase exponentially.
Mhm.
I mean, the amount of stuff that I do today compared to what I did a year ago to obtain business is, I mean, literally 10x. I mean, that's the nature of the beast, though. And one thing that I do see potentially being an objection people are going to be getting here pretty soon is in regards to the whole banking situation that I was talking about a few minutes ago. I mean, if you go do a Google search on it, you'll find the most horrifyingly stupid headlines you'll ever see. Obviously, it's bad that bank went under. That's not good for a lot of people. But it's also not the end of the world for the rest of us. And a lot of the fear is pretty easy to sell. I mean, that's why horror movies, do so well. It's easy to get people to click on something that says that everything's going to crap. So that's how a lot of the media outlets are going to present that situation. Well, the fact is that bank is going to crap. It already did. It's going to impact the businesses that did their banking there. Presumably, there will be some exception made to the regular FDIC thing, and the government will probably step in and do something about some of it. Whether that's right or wrong from an economic perspective, I don't know. I'm not qualified to answer. But you're going to have people that are saying, well, I think that everything's about to collapse because this one bank went under.
Well, Matt, I think a lot of
bank
things
out of thousands and thousands.
Yeah, and I think a lot of the individuals out there are going to start replaying, the 2008 crisis. I mean, guys, I think that's kind of what's going on. And take this for what it's worth, but I was listening to a Dave Ramsey thing this morning, and he was talking about this, and how the media is, they're going to use the fear factors, and basically he said that the majority, and obviously, I don't want to get into a whole lot of the legality side of things, but generally speaking, FDIC will cover up to $250,000 accounts. Well, he said the majority of this banking institution was the majority of them were hedge funds or business startup accounts. So they obviously had a lot more money. Well, he also said that this bank only kept on hand around 10% of their assets. They had literally gambled with approximately 90% of the funds that were there. Well, whenever word got around that some issues were going on, well, they did what they normally do. They tried to short the market, not intentionally, but they wanted their money back. Well, they end up shorting it essentially, and that's what happened. So, but I think a lot of our everyday consumers are going to start replaying the 2008, housing crisis. Well, the good thing is, guys, I mean, how many of those buyers are buying right now? Well, guys, I would think that the average age group right now of buyers were probably pretty much in school at that point. They probably didn't even think anything about it as far as it goes, because a lot of the people who are scared, how old are they now, Matt? I mean, they're probably the ones who got hit the most are. Yeah. I mean, absolutely. Well, the ones who got hit the most were probably that
Gen X. So that's going to be more like,
I want to say 45 to 60, maybe.
Yeah.
50,
yeah.
Somewhere in that gap. And so, guys, I mean, the majority of the buyers right now, they're our age. They didn't, yes, we were aware of those things, but it didn't really affect us. So, I mean, I'm gonna say we're too dumb to be scared in a sense because we didn't experience that in the way that they did. So, pay attention to those types of things as well. And obviously, from an agent perspective, as we are dealing with these clients, I mean, if we're dealing with someone who is in the older demographic or older age bracket, guys, our conversations are going to have to be a little bit different because they truly may be scared because I mean, depending on what happened to them in 2008, I mean, a lot could have happened to them. We don't know what kind of PTSD they have from it. So our conversation has got to be a little bit different. Well, as we are dealing with first time home buyers that may be in the, we'll say 18 up to, we'll say 18 to 40 bracket. Well, guys, the conversations may be a little bit different there. And that's where we as agents have to be skilled in our artwork of selling and talking and negotiating. We have to be skilled. And guys, I'm not saying to be skilled in the sense that you sell everything. I'm saying we've got to be skilled in the sense that we can talk to anyone and everyone. We've got to be skilled to where we can put those problems at ease. We've got to be skilled in the manner to where we can help them to overcome that fear. And at the same time, we've got to be knowledgeable enough in all of these areas. I mean, don't talk about things that you're not familiar with, but we've got to be knowledgeable and we've got to understand those concerns. Because truthfully, if someone comes up and they talk about the 2008 housing crisis, guys, I was a freshman in college in 2008. So if somebody's talking about the housing crisis and they were a direct impact of that time from 2008, well, I've got to be able to relate in some way. Well, obviously I don't even know where I was at that point. I was probably still at home, to be honest. But, I wasn't out on my own. I didn't have the mortgage. I didn't have all that. So, it didn't directly impact me in that sense. But yet we've still got to be able to connect with them. We've got to be able to have those conversations and try and educate and try and understand where they're coming from to help them overcome those hesitations. So,
And I think too that one thing that everybody should be hyper aware of is the generational differences in those hesitations. This is
absolutely.
something that's been kind of fascinating to me. I mean, I've done mortgages for people all the way from 18 to 80, probably older than 80, but it sounds nice to say it that way. But here's kind of like economic history 101 and how it impacts us today as people in the mortgage industry and real estate space. So there's not many of them left, but the people that were alive back in the Great Depression, if any of you had any, parents, grandparents, great grandparents, whatever that was in that time in history, just about every one of those people that I knew were the most frugal and least wasteful people that I've ever met in my life. I mean, you're talking about a generation that might have been born in the 20s, experienced the Great Depression, and then probably had something to do with what was going on with World War II, and then came home to follow it up with Korea. My great grandfather, who's not with us any longer, my great grandfather served in World War II, Korea, and Vietnam. I mean, he just couldn't get enough, I guess. But the thing is, those type were all about, they didn't exactly trust banking. They didn't have any, their whole thing was they would go and work for the same company for 30 years, retire, get a gold watch, a pension, have Social Security. Their whole thing was, we need to have a paid for house. Because if they could do that, the pension and Social Security should be enough money that they could survive and live just fine going forward. The company was taken care of. That was the culture back then. Mm-hmm. Well, somewhere in the late 70s and 80s, things shifted away from pensions. I mean, I honestly don't know a whole lot of people that are not some variety of government worker that I've talked to in recent history that has a pension. And I ask everybody I talk to about their retirement because their mortgage is going to play into that. But around the 80s, it shifted over to that. Well, that's what impacted my grandparents' generation. That things moved over. They still have some level of pensions going on, but beyond the pensions, they still were, a lot of them saved up in 401ks. A lot of them saved up in thrift savings plans and things like that. They were still familiar with the concept of saving back then. I'll be honest with you. I don't know what happened between the boomers and Gen X as far as financial literacy goes. but I don't think they passed anything down to them, from what I can tell, talking to at least the people I talk to. Because what I see that happened there is a lot of them were a lot of Gen X. There is no pension for Gen X unless they're a government worker, from what I can see. There's going to be somebody out there that's a one-off, and you can email me and be like, Matt, you're wrong. My dad worked for Ford for 30 years and all that crap. Okay, whatever. But as a general rule, they needed to be saving in a 401k or something. Well, what that turned into was most of the people I do mortgage applications for, they ain't saved in the 401k anything significant. It's tougher to have to do it that way, but at the same time, we're all having to pay into Social Security. So that happened. Then you get into a lot of the people in that generation too. Here's what probably plays into part of the reason why their 401k doesn't have a ton of savings. They were at prime time for home buying and investment and earning capacity, and they should be hitting their stride in their career right when 2008 happened, as a general rule. Because you average first time buyers 33 years old, still is. Crank back the clock from 2006, you're in 1976 right there, right? So smack in the middle of Gen X, first time home buying, prime time age, compounded with the fact that they had retirement accounts that might have been starting up and then got the crap smacked out of them right there out the gate. So a lot of them don't trust putting their money there anymore. And I could see
Matt,
that.
We just now had a comment come through, and there's a lot of truth to this. They said, one generation didn't talk about money. Another generation wouldn't listen when they were told about money. And
yeah,
and there's a lot of truth to that, guys. I mean, I was brought up in a household where, we didn't talk money. I can remember mom and dad sitting at the kitchen table or dining room table with like tax stuff spread out all over the place, trying to get everything ready. But they didn't talk about money. I mean, that's the one time a year that I actually saw them putting stuff out there. And guys, I'm very open in a lot of ways. I'm probably too open in a lot of ways. And I don't ever mean for that to come across bad. I mean, I don't have a whole lot to talk about anyway. But one day I walked in the house, and my oldest one, we were talking, and he was like, well, how much money did you make today? Well, thankfully it was on a day that I'd closed the deal. And it was a pretty hefty one. So, I mean, I was like, I didn't sugarcoat it. I told him. He's like, well, is that a lot of money? I'm like, well, some might think it is, but no, not really. And, so it opens up those conversations. And that is something that in my family, we deal with. I mean, if they ask me questions, I will answer it, and I don't want them running around telling everything that they know or don't know, whatever. But, at the same time, I want them to be educated. And I want them to understand how money works. And I want them to understand that, Bryson, my oldest one, he's still, I don't know why he thinks this way, but he still believes that if you give somebody, $2, that you're going to get change back. If you give that, if you always give them $1, that you're going to get change, well, it doesn't matter. And obviously we're still working on that, but you can ask them what an asset and liability are, and they can tell you what each of them are. And they've been able to do that since they were, I don't know, 2 and 4. And, now, do they fully comprehend it? No. But they do know what it is. They know how to answer that question. And so I'm gonna say financial literacy. I mean, that's some stuff that we've dealt with on a lot of different levels. And guys, there's nothing to be ashamed of there. Because at the end of the day, we've all struggled.
Yeah.
Go ahead.
I mean, there's there's a lot of truth in the fact that I think that for sure the boomers, from what I could tell, didn't talk a lot about any of that stuff, because back in that day, you don't talk about money, politics, or religion.
Mm-hmm.
Now you got everybody that can't keep their mouth shut about any of those things on Facebook. But 95% of them are wrong about one of those topics, probably. But the thing is, you fast forward to the millennials that followed Gen X. Me, Patrick, that's where we're at. He experienced 2008 as a freshman in college. I experienced it as a freshman in high school. I remember, yeah, old guy over here. What I remember about 2008 was that one of my grandparents purchased and constructed a home right around, I think, 2007, if I remember correctly. And then they had just retired while building their dream house. 2008 happened, pretty much turned the 401k side of their retirement equation into a, piggy bank for a second there. And by a second, I mean several years before it recouped that and recovered from that. They did talk a little bit about it because they were like, this is insane. Like, we basically just got hosed. And they're, I remember that. I remember, thankfully in Middle Tennessee, I don't think that it hit a lot of people as hard, but I do know some people who had it very tough during that time frame. But all that I remember was lenders were stupid. Mortgage people were stupid. They gave out money to people that didn't need to have the loans given to them. And that was all that I knew about it until I got into the industry. When I got into the industry, it honestly took me a couple of years, and I happened to be procrastinating on my CE. Don't procrastinate on your CE. Learn my lesson. Don't do that. But I procrastinated on my CE a few years ago, and I went and did it in person to knock it out. Well, when I did that, of course, I wasn't surrounded with people my age, because the people doing their CE in person are either procrastinators or old. I was talking to them about what it looked like in the mortgage industry back then, when I was in high school. And what I found out was some of them were describing deals like they would carry bankers boxes. They'd fly bankers boxes to an investor somewhere. People would open it up. The investor would open it up, look at a couple of them, and they'd be like, all right, we'll take them. We'll pay you this much for loan files. Like, it was literal paper loan files at that time. And they would, I was like, man, that's, of course, me being me, I can't keep my mouth shut and not say stupid stuff. So I was like, that sounds a lot like a drug deal. And he's like, well, I've never been involved in a drug deal. I was like, me either, but it looked like what you see on TV. And anyway, he's like, well, I guess, yeah, it was exactly like watching Breaking Bad or something. Then they talked about how it wasn't, they were incentivized more to sell those terrible products. Like, I've always thought, wow, how could you be an idiot and do that sort of thing? They were pretty much told, you sell this crap or you don't work here anymore, because they were the more profitable things at the time. That gave me a whole lot more sympathy for some of those people whenever I found that out, because I was like, I've always looked at it just like, you guys were the buttholes that killed the economy for a couple of years. Well, that's kind of my perspective on it. You get down to the Gen Z people, and I'll be honest with you, like, I still ain't sorted that out. They say a bunch of stuff and I don't know what they're talking about half the time. But the thing is that we're going to run into those sorts of perspectives and thought patterns depending on the age bracket that we're dealing with. And they're all going to have different opinions on what's about to happen here. The millennials, the other thing that I will say about the millennials that's not directly related to mortgages and housing, but to general finance, is, I'm going to say something super controversial here, so brace yourselves. I think that the millennials were sold a bill of goods. We were sold a lie about the utility of college. And you've got an entire generation that was told that if you don't go to college, you're not going to amount to anything.
Yeah.
So go take out an extraordinary amount of debt to get through college, and that'll turn into something magical for you. Well, the problem is go on the business front. I've got an associate's degree. On the business front, like when I was taking the business class, I think the first thing that I learned in economics was supply and demand when I was there. And they were like, yeah, if you've got a lot of something, it's going to be worth less. If you've got a little of something, it's going to be worth more. Okay. Well, somewhere that that disconnected from reality for the number of people that got college educations. So if everybody's got an accounting degree is not worth nearly as much as it used to be, but then it still costs the same amount or more to get. And that's preventing a lot of millennial generation from being able to comfortably buy a house, because they're like, I got my house payment right here. It's called student loans. Now, there are things we can do, like talk to them about income-driven repayment plans and stuff of that nature. A year or so ago, the FHA hooked everybody up and gave us the opportunity to actually count that payment instead of the 0.5%. No, I'm sorry. I think it was 4% back then that it used to be. That did open up the doors to homeownership for a lot of people. but that's still lingering in the back of their head. So many of the
Well,
people that I talk to, like, that is the thing that holds them back from buying a house right now.
absolutely. And guys, I'm going to go out here and just say, I mean, for those of you who do not know me personally, yes, I used to work for the government with student loans. I know way more about student loans than anyone tends to care about. But basically, one of the things that I saw while I was there is, and again, I'm gonna go out on the controversial side. Yes, I did go to college 4 years, but I only came away with an associate's because of everything. But yes, I've had all my high level business classes, all that. So I'm not a fan of the system in that sense. I'll be full disclaimer. But here's what I saw when I was working for the government with student loans. I would see individuals who, and I saw some comments come through, talking about all this stuff still continues today about, you go to college, you get a degree, you get a good job, etc. Guys, I don't want to knock that because it is right for some people. And at the same time, for me though, and me being an entrepreneur, it was not the right fit for me. And yeah, like I said, I went all 4 years, did all my classes, but then I got screwed by the system. And so anyway, I quit. So long story short, what I saw when individuals would go to school, they would come out with an associate's and they couldn't find work. They got the first degree, they got out there and started trying. Well, they couldn't find anything more than a minimum wage job. Well, anybody can go and get a minimum wage job. Well, then they would go and sign back up for school. They'd get their bachelor's. Well, they'd come out and they still could not find work in their field. Well, then they would go back to school and get a master's. They'd come back out into the workforce and they still were not getting the compensation that they felt that they needed. Well, then they'd go back and get a doctorate at times. Guys, by the time they got finished with school, now they were too old for most companies to hire. And so that was a direct impact at that time. And I think that had a lot to do with a lot of the financial stuff that we went through. And now a lot of people are strapped to the student loan payments. And I'm not going to get into a whole spill of student loans, but guys, if y'all do have questions, I can help you with a whole lot more than a lot of people, because I've had a lot of training over the years. But basically, they got trapped in such debt that they never could see the end of it. Well, guys, that hinders the mortgages. It hinders our home buyers, because now that certain demographic, they've got all this debt racked up. Well, yeah, it does impact a lot. And yes, there's ways around it, but truthfully, it's where we've got to look and figure out what is the best route. How do we handle those buyers? And I will never forget, I had a client several years ago and they had run into some student loan things and they were dealing with Matt, and Matt told them and said, look, Patrick, you need to talk to him. So they called me. And after spending a few months of working with them and making some phone calls and advising and helping, we were able to close on, $400,000 house at the time. Guys, there's ways around a lot of that. But at the end of the day, we've got to be educated on what our clients are dealing with. We have to be educated on the problems that they may have, the questions that they may have. And that's where education comes through. And that's where the skill of selling and being the agent comes in. It's not that we've got to know everything, but we've got to be able to help talk them through those situations. Guys, while I was there, I literally saw a loan that was $700,000+ in student loan debt. Basically, it was a man and wife. They'd met in med school. They consolidated, and long story short, it was accumulating over $1,000 a day in interest. Well, what happens? Well, it was accumulating $1,000 a day in interest, or it was over. But by the end of the year, whatever interest was not there, it compounds. It adds onto that mortgage or onto that loan. Now it goes up the next year. Guys, long story short, they're never going to pay that off. They both dropped out of med school, by the way. I don't know if they ever went back or not, but that's one of the scenarios that we dealt with while I was there. Guys, they're never going to see the end of that. And, Matt and I had a client last year, I believe, that had, if I'm not mistaken, multiple masters, or at least, they had multiple degrees that, sounded fantastic. Guys, they couldn't hardly afford a $160,000 house because those degrees They were not able to find the work that they needed that, you know, would pay that back. So what Matt was talking about with all the different brackets coming through of age gaps and stuff, you know, guys, everybody's dealing with that. And here's one thing that I want to express. I mean, a lot of times I always say that I mean, yes, I did go to college 4 years and all that, but yeah, I did drop out for a little bit, and I went back and finally got my associates because I couldn't get anything else. And but anyway, I was so upset with the system. I was like, you know what? Forget it. I'm done. Guys, I hear people all the time say, well, I don't have a college degree. Whatever. Guys, do not be ashamed of that. You know, if you're hanging around the right people and in your right group, guys, you can make way more money without a degree than anything. If you do, if you choose to. Now, for those of you who did spend all that time in college and all that stuff, good for you. I'm glad, and I hope you enjoyed it, whatever. But as entrepreneurs, as real estate agents, as self-employed individuals, do not let those thoughts get in your way. Do not let those thoughts hinder you. Do not let them slow you down, because at the end of the day, guys, it doesn't matter if you have a degree or not. I mean, because I know agents who have multiple wonderful degrees hanging on their wall, but they can't close a deal. Then I know agents who don't have degrees that close deals all the time. So guys, it means nothing in the self-employment world. It means nothing in the entrepreneur world. So just know that those hesitations that you have in your head, those feelings where you feel down for yourself, maybe you couldn't afford to go to college. Maybe that's been an excuse. Well, I couldn't afford to go. Guys, get rid of that one. Maybe you went to college and dropped out, whatever, like I did. Guys, get rid of that excuse too. It doesn't matter. At the end of the day, it matters with what we do every single day in this line of work and how many people we're able to help. And our job is to help them to overcome their fear. Our job is to be able to connect with them, to help them overcome the hesitations that they may have, which is often driven by fear. It may be a past issue that they've dealt with. So it doesn't matter what, we got to get rid of those excuses. We got to get rid of the blame, and we've got to focus on what we can do and focus on helping more people. And ultimately, what matters is showing up every single day, working the 4 pillars, and just 10xing the amount of time and effort that we're putting into it. Matt, I know we're running tight on time now. Do you have anything to wrap us up with?
Yeah, I think that to put a bow on it all, you know, a lot of this stuff probably sounds a little bit negative. Obviously, we're talking about banks crashing and, you know, the Great Depression and stuff. So, yeehaw. But the thing is that even in spite of all that, somebody that bought a house, you know, 20 years ago, that house is worth 274% more than it was 20 years ago. There was a little dip there for a lot of people. If somebody bought a house last June, there's probably going to be a little dip for them right now. But here's the thing. I looked at numbers yesterday, renting versus owning. And if someone's paying $2,000 in rent right now, and compare that to buying a $350,000 house with nothing down, mind you, the difference in the financial picture in 5 years is this: if in 5 years you continue renting on that $2,000 and it increases, you know, incrementally each year, that family will have paid in almost $130,000 in rent over 5 years. $130,000. On the flip side of that, without taking into account any sort of appreciation, they will have paid about $30,000 of principal down and gained that much equity. You factor in appreciation, and you're probably looking at equity somewhere closer to, you know, $50,000 or $60,000, and that's very conservative. So you're talking about a flip right there, a flip of the coin for a family's financial picture of about $170,000, conservatively speaking. Like, that's huge. Like $170,000 is freaking huge. That's why the average homeowner is worth 44 times more than the average renter. And that's why what we do is so important. Whenever you're talking to somebody that's a first-time buyer, or somebody that says, I'm thinking about selling my house, I may rent for a little while and wait to see what happens, have that conversation with them. Send them over to me. I'm happy to talk to them and show them the numbers and how they literally shake out for whatever their scenario is. And because to me, like that right there is the most important thing that we all do. Whenever you're having that call reluctance and saying, well, I don't want to bother. I don't want to bother them. They told me they were going to buy a house this spring, but I don't want to bother them because, I just don't want to be a bother. The value of that conversation, if they're paying $2,000 in rent right now, is $130,000 over the next 5 years. 170 or so when you count the equity. I'm not gonna lie. Like if I knew that every call, which I do, that's why I enjoy this job. But if I knew every call that I make is worth $170,000 to somebody, that's some pretty big information for them. Here's one other example, and then I'll shut up. I talked with a family yesterday. Somehow we ain't got into all this. Somehow they got a paid for house, and on the other side of the coin, they've got about $170,000 of debt. They were worried about moving, relocating to Tennessee, and worried about house payments and stuff like that. Well, their total payments right now is over $3,000 on the other debts. Like, I was like, hey guys, just sell your house, pay all that crap off. You can have a new house payment equal to that and use the remainder of your equity for your down payment. You're going to buy a house up here that's about $650,000 and nothing changes for your financial picture. That's the type of stuff that we do. That's the type of stuff that we've got to be bringing to the table. And hopefully this gives you some of the tools that you need to understand what you're working against whenever people come to you with some of their objections. And hopefully it gives you a little bit of insight on how to educate them around that.
Absolutely. Well, guys, we are right at the 9 o'clock hour, so we'll go ahead and wrap everything up. Again, thank you all for being on here with us. If you all have any questions about anything, please feel free to reach out to Matt or myself. We'd be glad to help any way we can. But again, guys, happy Wednesday. Enjoy the rest of the week. We'll see you guys next week.